Welcome to our November 2024 Analyst Report. My name is Brady Albright, and I'm joined with Jonathan and Nicholas. And today we're going to be reviewing Amdocs Limited, one of the companies we currently hold in our portfolio. We are going to be covering a brief company overview, as well as our current thoughts on the company and their position in the market. And we are going to also cover a brief outlook on the industry and their financials moving forward. Our team of analysts recommend a sell for Amdocs Limited. They currently operate in the software and IT consulting industries. Their current price is $83.98 compared to our 2-year target price of $93.54, representing an 11.39% upside. They have a market cap of about 10 billion, and they're currently trading at a PDE of 19.76. Amdocs offers a variety of different products and services to connectivity and telecom providers. These services utilize generative AI to come up with solutions for customer service, automation, IT, and operational efficiency. We believe in the divestment of our shares for a number of reasons, including their underwhelming results in 2024, their stifled expectations moving forward, an increase in competition amongst the market, as well as our current portfolio alignment goals. So starting off with their underwhelming performance in 2024, they recently came out with their fiscal year ending at a 2.4% revenue growth rate, and this is well below what our initial estimates were with the SMIF program, as well as missing expectations on their earnings as well. In the Q4 earnings call, Amdocs adjusted their outlook for 2025, including a 2.7% growth rate in their revenue, which comes down way below what our initial analysts had estimated, around 10%. And so we had to adjust our outlook for the future moving forward. As you can see, revenue growth looks a lot different from previous estimates, as well as a decrease in cash flow and earnings per share as well. We are also noticing a large increase in the competition in software as a service, as well as in the IT consulting field. In doing so, we don't believe that Amdocs is one of the strong players in this field. In software investing, there is a rule of 40, which means your EBITDA margin and revenue growth should add up to 40% as a general rule to be able to be a viable company to invest in. However, we see that Amdocs is currently not reaching these goals, and they are expected to completely miss these moving forward as well. As we stated earlier, we have updated our 2-year target price to $93.54. We have estimated an annual return of 5.7% for the next 2 years compared to the previous of about 12%. So as you can see, this does not currently align with our goals in the portfolio, and thus we recommend the divestment.
Our 2-year price target sits at $93.54, which represents an upside of about 11.4% from the current share price of $83.98. We arrived at this price using a weighted blend of price to earnings at 10%, EV/EBITDA at 10%, EV revenue at 10%, and our DCF at 70%. For our DCF, we had an 81% weight for our equity and a 19% weight for our debt. We had a WACC of 7.2%, and we used a perpetuity growth rate of 2%. These metrics led us to an implied value per share of $93.42, which lands extremely close to our original weighted target price. For our other valuation metrics, we had price to earnings at $96.70 a share in 2026, with a 20% downside of $67.69 and a 20% upside of $118.94. Our price target for EV/EBITDA lies at $90.74 with a 20% downside of $72.59 and a 20% upside of $108.89. For our EV to revenue, our 2-year price target has $94.06 with a 20% downside at $60.86 and a 20% upside of $134.45. The software industry is expected to grow at an average annual rate of 10% over the next 2 years. This represents a slight deceleration compared to the higher growth rate of the prior 2 years. However, the industry remains attractive overall, and the main drivers for growth are artificial intelligence, data centers, and public cloud software. As for the industry growth, it is mainly driven by the top 5 firms, which are Microsoft, Oracle, SAP, Salesforce, and Adobe. These firms account for 42% of the market share. So this market is very concentrated. Challenges impacting this industry's growth include sensitivity to interest rates, as companies rely heavily on capital-intensive research and development investments to sustain their market position. The Fed's recent indication that additional rate cuts may not occur in the near future adds to this pressure.
If we take a look at the comparable companies for Amdoc, we can see that Amdoc is a significantly cheaper company than its peers. And this comes from that all of its valuation metrics are lower than its peers and the average of those. However, if we take a look at the margins of its competitors, we can see that Amdoc is completely underperforming its peers and the industry overall. ROA, ROE, ROIC, and gross margin are all lower than the industry average. This could be a significantly good reason for why Amdoc is a cheap company compared to its peers. If we now take a look at the ratio analysis, especially the profitability and ratios, we can see all the ratios are pretty stagnant, and this has occurred since 2021. If we take a look at the graph, we can see gross margin, operating margin, and free cash flow margin are almost like linear horizontal lines. So this company, Amdoc, does not show any indication on becoming a more profitable business. Amdoc is facing increasingly more geopolitical uncertainty because it's an international company that operates out of the islands of Guernsey, has its main subsidiary in the US, and has its main or base currency in the US dollar. Is facing currency exchange issues because the US dollar is keeping on appreciating, which is devaluating its revenue that comes from outside of the US, which accounts for 35% of its total revenue. Amdoc also has 15% of its workforce in Israel, which is also facing a really unpredictable future. The industry Amdoc is working in, the software industry, has a really low barrier to entry and has increasingly more competition. Amdoc states that they are facing more competition in communication, customer experience solutions, and in the media industry. They're also facing competition from internal IT department at its customers' IT departments. Amdoc is also a really limited company with customers. Its main 2 customers, AT&T and T-Mobile, account for 50% of its total revenue. Should one of those companies choose to not work with Amdoc anymore, they will lose around 25% of its total revenue. Amdoc says that they are facing increasingly more data and cyber attacks, and they also claim that they are not able to detect all threats in time and breaches. They actually state that they are not able to detect these breaches in any significant time after the breach has happened. If we look at the graph on the slide, we can see that cybercrime is expected to explode exponentially over the next 4 years. As in 2024, the cost for cybercrimes were $9.22 trillion, and in 2028 is expected to be $13.82 trillion in cost. That was it for this presentation. Thank you for listening.